Good morning, traders. This is Ken Calhoun with DayTradingUniversity.com, and in this session, I'm going to show you what I look for in making multiple entries, or several entries at wide range gap stocks. And this is a perfect example here today on Wednesday, May 9th, 2007. We're going to look at just two charts today. The first one is DNDN. And what I want to bring your attention to today is this stock is it's a two-day chart, closed off yesterday up at just under 18, opened up today at around 8, and has been trading flat ever since. As I record this, it's in the pre-market. It's just on 9:16 a.m. Eastern time, so about 15 minutes before the opening bell, and obviously the traders aren't pushing it one way or the other significantly outside of its current pre-market trading range. Again, this highlights the need to have your pre-market chart so you can see the volume and the pattern or trend, if there is one, in the pre-market before the opening bell, so you can be much better prepared to trade a gap continuation or a gap fade in these charts as they move. Here's what I'm looking for personally. Here with DNDN, the first short that I look at is at 7.4. And there's a couple of reasons for that. This is, and it's around 8 here. I want it to lose 7.5. I'm using a half points as our support and resistance levels, simply because those are levels that traders are likely to use, especially for the cheaper price stocks, or newly cheaper price stocks as this one is in today's session. So 7.4. The short trigger I'm looking at. What would be the next short trigger after that? I would use, say, a 6.8 or a loss of the 7 whole number support on this. What about a long trigger? Where would we look at for a long entry in this? I would use a 9.3. And why wouldn't I use something closer to the current trading range? Well, simply because that's where a lot of bounce traders will likely enter, and market makers will be gunning for stops here. So if we're looking at our, say, 8 as the line in the sand here, the median price line for this gap, one of the points that I want to make is that you do not, or I do not, trade within the obvious support or resistance. Instead, I want it to break over, and this would be where 9 is at. I want it to get up over 9 for a possible long play. And again, the preferred play would be to simply kick a weak stock when it's down and go for a short, which would be the preferred play down here on a loss of the 7.4 as the first short trigger. Okay, and then a 6.8 is the second. Let's say, however, that the stock moves up and you were trading something else or weren't paying attention and you didn't catch a long at 9.3. How do you set successive entries? That's the point that we're going to make in today's session. I simply look at the average moves over half and whole number support and resistance levels, plus using our volume, and we may use other indicators like stochastics or MACD or moving averages, but it's much more effective to simply use our half and whole number support and resistance along with time and sales for tape reading to gauge the strength of that equity as it's moving to support and resistance levels. Let's take a look at our other chart here. There's actually two others we can look at, but here is the strongest pattern of the other ones that we have here. Cisco, you can see, is gap down from 28.4 to 27. Is this as strong a gap as DNDN? No, obviously not, because the magnitude of the gap is a full 10 points, and the volume accompanying that gap, which is the other measure of the net buy or sell pressure in that stock, and where the market makers are looking to open it, or the institutional traders, you can see the volume per minute is averaging right under the 200K per minute area. So it's a much stronger, and therefore a stock that I would be likely to trade more aggressively. This one I'd be over all day today. Multiple entries on successive whole and half number breakouts or breakdowns. Whichever way the stock goes, I would be aggressively trading DNDN. If we look at Cisco, hey, this is a 1.5 point at best, 1.4 point gap. So this one is not a very good trade setup. However, we would look at what for our entries. I would be using about 26.8. I would play it fairly close to this. I wouldn't make it move very strongly, even though it's likely to just come down here and chop and very slowly move. That's where I would look at for the first short. Next short would be just under, say, the 26.5. And for the first long, cautiously say a break over the 27.2. So the first lesson that you want to do in looking at gap entries, folks, is make sure that you're setting a trading channel, an immediate trading channel, or lines within which you will not trade. Okay, because this is likely to be where there's going to be the most chop and disagreement from traders, and the most chop and churn within that equity, and you want to avoid trading inside that range. Instead, look for breakouts or breakdowns outside of that range. And the last one we'll look at is FWLT. How would you set a long continuation trigger for this? I'm using, I would be very conservative, 81.4. And again, you can't see the gradations of how far up this would be, but 81 would be about here. Okay, if we were to draw the lines, it'd be about here, and I'm looking for it to clear that whole number, 81 resistance, and then another 3/8 of a point or so to use our fractional talk, which would be 0.375, or around that up to 0.4. So 81.4 would be the earliest I'd be looking at going long this equity, and I would be trailing the initial stop at the 81. So no more than a 0.4 trailing stop. And again, we like to go in the direction of the gap as our preferred bias, but that certainly does not stop me from setting fade entries as well, because we never predict price action, we only react to it. Again, that's a professional trading approach. You can see this would be the immediate support at 78, and I'd be okay with a short at, say, 77.8, just about a quarter point under the 78. And again, this is the same exact thing, the region within which we would not trade. And again, taking that same approach with DN, the first thing I want you to do, folks, is make sure that, number one, your trading charts are set to measure or to display data at 8 a.m. Eastern, which is when the data starts to hit and when the pre-market trading is going on. Even if you don't trade in the pre-market, and that's certainly fine, pre-market trading is only for the most experienced traders. At least you can get a feel for where the price action is of that equity, and where to avoid, therefore on the open, where that stock is moving, plus the size of the volume. And you can see the traders are heavily trading this stock. 200,000 shares per minute in this stock are being traded, but there's not enough movement in that stock in terms of the overall price action to warrant an entry for us, at least. If it was strongly trending, yeah, I'd look at an entry. But since it's relatively flat, this is technically a descending triangle. If you were to draw the small trend line going downwards here, it's a descending triangle, therefore a short bias. And as I said, I'd be looking at 7.4 as the first short and 6.8 for the second. And on the long side, 9.3, maybe 10 1/4, 10.3 on the upside. And that's it, folks. So that's how to set entries, multiple entries for gap stocks using the very best examples. This is Ken Calhoun, DayTradingUniversity.com. Make a great trade out there, and have a good one. Thanks a lot.